Shares of Peloton have fallen over 97% from their peak during the pandemic, but a lot has changed with this company, and I continue to think that this is one of those stocks that has a ton of potential to turn around the business long term. One of the challenges looking at Peloton is it's not the same company that it was in 2020 or 2021 when we had that stock peak, when the people were buying bikes like crazy during the pandemic. This is a very different business today than it was then, and we need to start judging it very differently as well. There are certainly some challenges. There have been hardware challenges over the last couple of years. Peloton is having trouble communicating some of their changes that they made about 6 or 8 months ago with the way that their subscriptions and their app subscriptions work. But I think they do have the right business model going forward. It's just going to take time for that to actually accelerate into a solid business. So I want to dig into the progress that Peloton is making in this video and talk about what we should look for in calendar 2024. Management is basically expecting a weak next couple of quarters as we get into the late winter and into spring, but things could pick up later in the year, in the calendar year, into their next fiscal year, which starts in July. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with a couple of charts and just show where we are financially with Peloton. You can see here that revenue has been kind of all over the place for Peloton over the last couple of years. But there's some things to note with this, that revenue is going to be relatively volatile because they are still a hardware and software company. The hardware, as they sell more bikes, more treadmills, the revenue is going to rise. And if they sell fewer pieces of hardware, revenue is going to fall. And those numbers are relatively big. You're selling one of these devices for potentially thousands of dollars. And then the ongoing revenue is just going to be up to $44 a month, I think is their highest price point right now. So that's multiple years worth of subscription revenue that you're going to make in hardware revenue. But that hardware revenue is going to be relatively low margin. I'll get to some of those numbers in just a second. But that's one of the reasons that the numbers are so volatile for Peloton, because if they sell a little bit more hardware, revenue suddenly goes up. Margins can even go up, but that doesn't necessarily mean they're sustainably profitable. The next thing to look at is Peloton's operating expenses. And I think this is where CEO Barry McCarthy has done a good job maintaining some of these costs, keeping them from growing like crazy like they were during the pandemic, but can probably be more aggressive in cutting these costs, whether it's sales, general, and administrative costs, R&D costs, or other operating expenses. I think one of the things that's interesting to think about with Peloton is they're doing a lot in the background trying to turn this business around. In the most recent conference call, McCarthy talked about it like they were in survival mode over the last couple of years. And now they're just getting to the point where they can think about, how do we grow this business again? So things like R&D, you might be brewing something, maybe it's a new piece of hardware. We know that they've been working on some more personalization things for the app, but those costs come up front and we don't see the fruit from that for quite a while. So I'd like to see these costs come down, but I do want to give a little bit of leeway for management to be building the things that are going to ultimately grow the company in the future, but worth keeping an eye on what these operating costs are. The next thing we need to look at is where the money is coming from, because at the end of the day, Peloton wants to be a subscription fitness business. This is going to be a software as a service business. This is really much more of a streaming business like Netflix is or like Disney Plus, as opposed to just selling a piece of hardware in sort of the typical fitness business model. So they want to have ongoing revenue coming from a growing number of buyers so that they can leverage their content costs. You film a class one time and you can distribute it hundreds of thousands or millions of times to people all over the world. So you need to have those subscriber numbers growing. And that's where we see the challenges start to emerge for Peloton. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is the fiscal second quarter shareholder letter, so the quarter that ended in December. And you can see that there's a couple of troubling things for this quarter and then for their guidance for the next couple of quarters. One is that their member numbers are down slightly, not a big drop in members, but you want to see this number going up and you want to see it going up consistently in much larger numbers than in single digits, if at all possible. The second thing is the ending app subscriptions. And this is where the app, there were some changes to the app and the way that those subscriptions work that I think turned some consumers off, but ultimately long-term should bring more consumers into the fold. So you've got something like 18 to 20 different types of workouts that you can do with the app. You don't need to have a piece of Peloton hardware. So again, this is moved from a company that was reliant on selling a piece of hardware and then tying software to it to now you can just be part of the software ecosystem. But right now, this number is starting to go down. And this churn number is really concerning. 7.2% is an incredibly high churn number. Now, management did talk about this and said that they're expecting to see churn be relatively high early on because you sign up for an app, maybe you cancel after a month or two. But the people who are going to stay for a very long period of time. So that churn should sort of go down over time and hopefully land in something more like 3-4%. I mean, 2% is what Netflix has from a churn number on a monthly basis. I think that's probably a little bit too high for a goal, but 3 or 4% would be phenomenal for Peloton. But this is really the reason that you want to see those subscription numbers go up. Subscription revenue now exceeds product revenue, $424.5 million. If you look at gross margin, the gross profit for subscriptions, $285.6 million. For hardware, $13.8 million. So basically breaking even on hardware, that's going to be the strategy. This is going to be a razor blade model for Peloton. And you make all of your money on those subscriptions. Like I said, now you're breaking that tie though between hardware and software. And this is where Peloton has a communications challenge. I think that's just naturally what's going to happen. But they are consistently profitable on a gross profit perspective. But I talked about those operating costs before. You just have operating costs that are simply too high to be either net income positive or free cash flow positive, at least for the time being. So I want to see those numbers continue to come down. You've seen the reduction in operating costs, at least on a year-over-year basis, but need to see those operating expenses continue to drop and the revenue side, the subscription side, start to grow in a much more meaningful way. So the challenge for Peloton is really turning into a business that can grow organically over a long period of time. I think they have the right strategy. You don't want to be tied to selling a piece of hardware, making money on hardware, and then hoping people want to keep subscribing to your service long term. You want to be the go-to place for digital fitness. And that's really what they've started to become. And what's interesting is in the last few months, I've seen more and more articles saying, wow, this Peloton app is really great for walking, whether you're walking in a gym or you're walking outside. I've used it for running, and I think it's a great running app, better than listening to music because it'll actually do some motivation. It'll tell you when you're supposed to turn around if you're doing an out and back kind of a run. There's strength content, there's yoga, there's meditation, there's all kinds of things you can do with Peloton. But to this day, that's not the way that most people think about Peloton. And that is, I think, ultimately, and that's what's going to make it very hard for this company to turn around. I think they have the right strategy, but how do you get to the point where everybody thinks about Peloton as just a fitness app and not necessarily a piece of hardware? And that's going to be the challenge for management. There are some potentially positive signs in the pipeline. They talked about personalization quite a bit on the most recent conference call. They have talked about doing more large scale sales. So corporate wellness, working with hotels. I think they can actually work with more hardware makers. There's a lot of companies who are making fitness hardware. Peloton doesn't necessarily need to be a company that's making hardware. They also have a number of assets that they could sell. They bought manufacturing assets in the US and then ultimately abandoned those. And now they're just operating under the same kind of business model that they were before. I think they could unload those kind of assets and actually improve the balance sheet. But the biggest challenge for Peloton is communicating with consumers that, hey, we've got a really good value for fitness in all kinds of different modalities, no matter what you want to do. I think in 10 years, 15 years, we're going to think about Peloton as just a natural fitness subscription that you pay $20, $25 a month for. And even if you just use it a few times a month, it's much better from a financial perspective than paying for a yoga membership or a gym membership, which can be hundreds of dollars. And even if you're going to the gym, it's actually got great content. But that communication that those things exist is really challenging for Peloton. So it's going to take a lot more organic word of mouth growth. And that takes a long time. That's really the challenge for Peloton. But I still think you have the right business model in the right market. That's where you're going to see success for a company like Peloton. But we are not seeing those results in the financials yet. Keep an eye on those subscriber numbers in 2024, operating expenses, and do they have any success in convincing consumers that this is much more than just a hardware company that was a pandemic boom and bust. I think they can get there, but it's definitely a high risk and high reward stock, a very asymmetric return stock. That's why I like it so much. But let me know what you think about Peloton. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next.